Welcome to this presentation on secondary market annuities. These are court-ordered income streams that Wall Street does not want you to know about. What if I told you there's a way to get guaranteed income from the same A-rated insurance companies that back traditional annuities, but with 1 to 3% higher yields and 10 to 15% lower prices? What if you could lock in safe, predictable income at yields that banks, bonds, and brokers just can't even touch? Most financial advisors have never heard of what I'm about to show you. In fact, only about 700 out of 330,000 licensed advisors in America even know this market exists. And here's what's even more interesting. The biggest buyers of these investments are Wall Street firms and the insurance companies themselves. They spend hundreds of millions of dollars buying what I'm about to show you. But first, let me be absolutely clear. I am not here to sell you anything today. I'm here to educate you about something that could fundamentally change how you think about safe, guaranteed income. It's going to be up to you to figure out if it's something that's right for you. So my name's Nathaniel Pulsifer, and I'm not just a broker in this little-known market. I own the DCF Exchange, which is the nation's #1 wholesale clearing platform for structured settlements. I've done over $500 million in transactions since 2011. With $15 million of capital in my inventory, I buy every single payment stream myself before selling it to clients. I have a 0.0% loss ratio. No client has ever lost a penny. But here's what makes this website special. This is my factory outlet. The deals you see here are not available to the 700 advisors on my platform. You get exclusive access to the inventory they never even see. So I don't just participate in this market. I bring the capital and the infrastructure to the entire industry. What you're going to learn today on this presentation are a few important points. First, the big picture. How recycled structured settlement payments create higher yields for buyers like you. I'm going to show you real examples of case studies with actual numbers and outcomes of some of my past clients. We'll talk about the mechanics as well, exactly how these transactions work and why they're safe. Then I want to tell you why we're in one of the best environments I've ever seen in this marketplace. Times are really good right now to lock in high-yield, guaranteed income. I'll also talk a little bit about the exclusive factory outlet website specials, when buying direct from me gives you exclusive opportunities that are not available anywhere else. We'll also touch on whether this is for you or not for you. You can determine if this fits your situation. Again, this is not a sales presentation. It is just education and an invitation to get exclusive access to deals you can't get anywhere else. So let me guess for a second why you might be here. Mainstream advice that people get when approaching retirement is really just terrible. It exposes you to volatility that you really can't afford when you just need guaranteed income. The 60-40 stock-bond mix, that just leaves you holding all the risks. But safe money options? Well, CDs and treasuries offer just about a 4, maybe 5% yield. That barely beats inflation. Traditional annuities are pretty similar, 4% returns, but they have complex riders, low yields, complicated surrender charges, confusing terms. Really, financial advisors pushing these lifetime income products really just know they have terrible payout rates and they're pushing them because of high commissions. Perhaps you want guarantees, but you're just frustrated with the options that are out there. Everything safe pays almost nothing, and everything complex just makes you suspicious. So let me suggest something. What you might really be looking for is what I call annuities for smart people. How about guaranteed income without the complexity of traditional annuities? How about higher yields without all the nonsense? Here's what changes everything. What if I told you that you could buy the exact same guaranteed payment from MetLife, Prudential, or Berkshire Hathaway, but get it at a 10 to 15% discount and a 1 to 3% higher yield? Really, just think about it like buying a used car. It's the same manufacturer, and in this case, an A-rated insurance company, the same reliability with guarantees from these top-rated companies, but you're just buying it used, so you get a great discount. The previous owner needed cash now, and you get the benefit. That's what a secondary market annuity is. It's a recycled structured settlement annuity payment that's already bought, paid for, and currently paying. You can have access to it now. This market really might be Wall Street's best kept secret. It's a tiny market too. The entire secondary market for annuities is under $1 billion a year. It might even just be $800 million this year. I own DCF Exchange, the platform that serves this asset class to advisors nationwide. But what you see on this website is exclusive inventory that is not available anywhere else. Even advisors don't see these deals. These are cherry-picked and factory direct pricing. Companies like J.G. Wentworth spend millions of dollars on TV ads because they buy thousands of these payment streams. They bundle them up and sell them on Wall Street for hundreds of millions of dollars. I buy from J.G. Wentworth and from dozens of other smaller factoring companies to bring the very best deals directly to you. So let me tell you a little bit about a few of my customers so you can get an idea of how others are using these payment streams. First, we'll talk about Dan. Dan, I'll call him the skeptical convert. He was a charter fishing boat owner, and he went from this sounding like a scam to referring new customers to me. He was initially very skeptical. "This just sounds too good to be true," he said. "What is the catch?" And I said, "You're right to be skeptical. Take everything to your attorney." He started out with a small purchase in 2011 with deferred payments that started out in 2021. He had income from 2011 to 21, and then he needed to fill in a gap after that point. He bought some smaller payment streams as well just to make sure that things were working, and he watched these payments come in exactly as scheduled. More and more payments came in 2021. Now he owns 6 payment streams. He just bought more a couple of years ago. He's invested over time, and he's referred others because he's just seen it work for over a decade now. He says it's the best decision he ever made. I love talking about Dan because he's always fishing. He always asks me how the fishing is up here in Montana. The next case study is Brett, who's a lot younger than Dan, but Brett's become a great friend because we've had a lot of chats. You see him here in this picture on a video call that we had together where he was talking about his experience in this marketplace. He's quite an entrepreneur, younger than me, and owns his own fundraising and memorabilia business. He wants to retire at about 50, and to do so, he's just been buying guaranteed income that starts in the 2030s, and it's going to go as long as he can make it last. He's too young really for any Social Security, Medicare, or other retirement benefits. He doesn't have any in his own personal business, and no pension fund. So he's using deferred secondary market annuities starting at his 50 or so. He's got about 15 different payment streams right now and counting, continuously buying. He likes that there's no market risk, no sequence of returns risk. He's got complete predictability and ready for his early retirement. He says, "I don't have to worry about the market crashing right before I retire. I know exactly how much income I have, and it's guaranteed." My next case study here is Mike J. Mike's a funny guy. He immediately got the concept because he's a used car dealer, and he understands the value of taking a little bit off the sticker price of an asset and getting a better deal. He's also got real estate that he flips, and he buys and sells some tech stocks. And he's a funny guy saying, "Take this money quick before the market crashes." Another one was he was just sending some money. He said, "I just sold a bunch of crappy houses. Take this money before I spend it." So he's got about 16 different payment streams right now over multiple years using lump sums and deferred income streams. He takes money off the table from his volatile investments because he loves the predictability and the guaranteed nature of these payment streams. The lump sums and the deferred income streams are bought in joint tenant's name with his good son, so that his good son can help take care of his wife and his other son. Those are his words, not mine. And I've helped him, had a lot of fun building out this portfolio and helped him put these together to take care of his kids and his wife for decades into the future. He has some very long-term payment streams. The last is another customer who's become a great friend. Jeffrey is 91 and just the most intelligent man I know. He knows a little bit about everything, anything from violins to colleges around the country to bond trading. And he's creating a ladder of income. He has over 70 different payment streams, lots of different payment streams, primarily lump sums, taking care and building a large ladder of income for his wife, his kids, as well as his grandkids and their college education. So he's seen a lot of families lose their inheritance in the stock market or get it squandered away. But doing this, he knows that his wife, kids, and grandkids will have guaranteed income no matter what. And it's just fun talking with him. I've actually had him out to my home, and he's enjoyed where I live and become part of my family and me part of his. He's a fascinating man. I love having customer relationships like this because these are real people. They're real life stories, and they're really happy customers. I would not have a business without these repeat customers. They give me great reviews and refer their friends and their family. Money is a personal matter, and a lot of folks don't want it known how much they have or what they invest in. Well, I've asked a few of these folks if they'd be willing to take calls and be a reference for new prospective customers. So towards the end of this presentation, you'll have the opportunity to set up a reference call with one of these past customers. The condition is that I need you to be willing to pay it forward if you become a customer and somebody else needs that extra nudge. Anyway, for now, let's just carry on. Let me tell you just exactly how this works. Structured settlements, the foundation of this entire market. They come about initially when someone gets injured in a car accident or medical malpractice or a wrongful death suit. It's usually some sort of personal injury situation. I'm sure you've seen this kind of litter on a stick, these billboards for personal injury lawyers. These ambulance-chasing attorneys are effective, though. They sue, or sometimes don't even have to go to court. They just threaten an insurance company, and they get a settlement for their clients. They take a big contingency fee as well. Instead of taking that lump sum settlement, however, many people elect to take payments over time. If they've been hurt or they're unable to work or for a variety of different situations, it may be more attractive for them to take money over time. Structured settlements are tax-free awards for individuals. Personal injury settlements are tax-free as well. So insurance companies making payments over time can make payments with interest to individuals, and the whole award is tax-free. These insurance companies step in to make payments over time, companies like MetLife, Prudential, and these payments can go on for 20, 30, even 50 years. Typically, they're guaranteed, they're tax-free, as I said, to the original annuitant, and these A-rated insurance companies make payments in the tune of $8 or $10 billion a year of new structured settlements. Then life happens, and that's where the secondary market comes in. The original recipient needs cash, let's say for a house or medical bill or business opportunity. They can't just cash out their structured settlement, but they can sell their future payments to investors just like you. The original recipient gets a lump sum, and you step into their shoes to get the guaranteed income stream that are part of their annuity contract. You're just getting it at a wholesale price. Think of it like a secondhand annuity. You're stepping into their shoes to receive the already issued and in-force annuity payments right from the insurance company. So let's talk about the legal structure, why this is completely safe. This is not some complex engineered financial product with a lot of commingling of funds. It's a straightforward legal assignment of an insurance company contract making specific payments. So first, there's court oversight in each of these transfer transactions. Every sale from a structured settlement recipient requires a court approval. Judges review and ensure that the sale is in the best interest of the seller. Public court records also document this, and they're public records. This legal process has been refined over 30 years, and it complies with laws that are on the books in every state and with IRS statutes. Your protection is that you have an assignment of an existing in-force, bought and paid for payment stream from the insurance company. These are guaranteed payments that continue regardless of what happens to the original recipient. We don't deal in life contingent payment streams. There is no counterparty risk here beyond the insurance company itself. And as to the documentation, I believe in complete transparency. Before you send in even 1 penny on a payment stream, I'll supply you with all the collateral in the file, containing the annuity policy showing the payments, the court order assigning the payments, the insurance company acknowledgement of the transfer, and then my assignment to you, transferring the payments to you through a payment servicing intermediary. The intermediary is a bonded, licensed, insured trust company subject to all federal regulations, and you own the exclusive rights to receive that payment at the payment servicing company. You're not investing in some person's promise to pay. You're buying guaranteed payments from companies like MetLife, Prudential, or Berkshire Hathaway, for example. There are many different kinds of payment streams for different goals, because these payments originally were structured to achieve specific financial outcomes for the original recipients. Once these payments are transferred, secondary market annuities can fill a variety of investment goals for a new owner like you. The top 3 uses that I see are income now, income later, and lump sums. Let's look at income now. These immediate income streams typically start paying within 30 to 90 days of a purchase. They're perfect for a current income need. The typical yields are 5.5% to 6.5%. So here's an example. A $266,000, $167,000 investment pays out $1,150 monthly, increasing annually for 31 years at a 6.25% yield. In this example, there's a cost of living adjustment. This payment stream increases 3% per year over the life of the payment stream. And when you get a look at our inventory page, you'll see a green More Info button next to the case like this, where you can download the complete payment schedule showing each and every payment, and you'll see that 3% step up from one year to the next. The next category of payments are income later or deferred income streams. These start paying in future years, and they're perfect for retirement planning and filling in Social Security gaps. Frequently, deferred income cases have higher yields due to time value of money. Sometimes they're 6.5, even 7% yields. In this example, it's a shorter term payment stream. I'm showing $152,558 purchase price, pays $2,680 a month, starting in 5 years and lasting for another 8 years. I use this example because it's perfect for filling a gap. Let's say you're trying to wait for Social Security to mature, or you're trying to produce income in the early years of retirement, but you might not need it in your later years. Deferred start, relatively short payment streams like this are perfect for filling gaps and virtually impossible to fill in the traditional annuity market. The last category are lump sums. These are single payments or sometimes a couple of payments on a specific date in the future. This is most analogous to MIGAs, multi-year guaranteed annuities like fixed annuities or CDs. Some of these have the highest yields as well, 6 to 6.5% depending on the time frame. So here's an example. $268,778 investment pays out a single lump sum of $562,500 in 11 and a half years. This is a guaranteed payment, and it will happen no matter what, pay to you or your heirs or into your IRA if you buy these in an IRA. It's just a single guaranteed payment from John Hancock. So people mix and match the different types of these payment streams to create their perfect income plan. Think back to my examples. I had Jeffrey, who has income and lump sums, primarily lump sums. I've got Dan, who has a lot of deferred income payment streams. Brett has deferred income streams that pay a long time, as well as big lump sums out in the late 2030s for reinvestment purposes. People mix and match different plans to create their perfect income plan. Use immediate income for your baseline or stable supplemental income needs, lump sums to coincide with major planned expenses or to give reinvestment options, and deferred income starting later in the future for your retirement needs. Really, it's up to you to determine what it is that you need, and then my job is to help you find payments that achieve your goals. Let's take a look at why there are better yields in these payment streams. The math will help you compare apples to apples so you understand why this is really a better deal. A traditional immediate pay annuity, here's an example. $152,984 premium to the insurance company will pay 20 years of $1,000 a month, 240 monthly payments. The effective yield on that is 4.9%, and that's about today's effective interest rate for new issue annuities from top-rated carriers. You get surrender charges, perhaps some fees, maybe a few complex riders, but this is a kind of a simple, period-certain annuity. By comparison, the secondary market annuity would cost $141,384. That's $11,599 lower price for the same $1,000 a month for 240 monthly payments from the same insurance company. The effective yield is 6%. There are no surrender charges, no ongoing fees, or complexity. The difference? Well, it's the same insurance company backing, it's the same payment stream and the same payment schedule. It's $11,000 lower price. It's almost 20% higher yield with no ongoing fees or restrictions. Why does this happen? Remember, the original recipient of those payments needed cash now, and they sold at a discount. You benefit from their liquidity need. The insurance company is still making the same payment that they've already been obligated to pay for all along. Everyone wins. It's not magic. It's just wholesale pricing in a market that most people don't know exists. Now, it's really important to note that a lot of annuities are sold on fear, hope, dreams, fuzzy logic, and using terms like roll-up rate, payout rate, crediting rate, bonus rate. None of these reflect your actual rate of return. So think about it. If you pay $100,000 for a SPIA paying $10,000 a year, that's going to be sold to you with a flashy 10% payout rate. But if you die 2 years later, you've received $20,000. That's not a 10% rate of return. You just lost 80% of your investment. Don't let terms like payout rate fool you. Go apples to apples and compare real math. In other videos, I'll talk about a confusing array of terms that you're likely to encounter in index annuities with income riders, roll-up rates, crediting rates, and things like that. But again, that's going to be apples to oranges. For now, let's just move on to things that you can actually verify. So with each payment stream, we go through a rigorous due diligence process. And here's how we confirm everything. First, there's the insurance company involvement in the transaction. They confirm the payments are available at the very beginning of a transfer. With the insurance company counsel and our own attorneys, we verify that all court transfer proceedings follow state and IRS statutes. The insurance companies acknowledge the transfer after the transfer court order is complete, and all transactions are set up and handled by a regulated and bonded trust company in numbered, case-specific escrow accounts. I buy each and every payment stream first, and my legal counsel's due diligence checklist is extensive. We've been in this industry since its inception. My irrevocable assignment of payments to you is also recorded and administered by the Payment Servicing Trust Company. Only you can sell, change, or modify those payments with the servicer in the future, and they make payments to you by direct deposit to your account. Remember, there's no commingling of funds or complicated cross-collateralization here. These are direct payments from the insurance company. So I buy each and every payment stream first before selling them to clients. If I wouldn't own it myself, I'm not going to sell it to you. In 13 years and on over $500 million in transactions, no customer has ever lost a penny. And that's because I operate with complete transparency. Verify things yourself. I encourage you to dig into due diligence on this. I operate with transparency because I want you to be completely sure of this market and satisfied with your payment stream. I depend on referrals, and I'm quite proud of my reputation in the market. So I want all my customers to know exactly what they're getting. Now, let's talk a little bit about the current market. It's really timely because right now is probably the best time in over a decade to get into this market. We have a perfect storm of factors right now. On the supply side, factoring companies like J.G. Wentworth are buying payment streams, but they're bundling, which is an interest rate sensitive business. Declining overall market volume is also pushing many competitors out. Remember, I said this was $1 billion, maybe $800 million market? We're in a pretty stable run rate, maybe $800 million a year. That's great for you getting into this market, but it's chasing a lot of competitors out who are going off to do other things. Frankly, I see that as a good thing. Also, economic uncertainty keeps forcing people to sell their future payments. So sellers need cash. And on the demand side, rising interest rates make yields really attractive right now. Wall Street is typically focusing on larger bundled transactions, and many individual investors just don't know that this market exists. My superior market presence and available inventory ensures an excellent supply of payments for you to choose from. This interest rate environment is really the best I've seen in like 13 years. Higher rates mean better yields for customers. There's an opportunity right now to lock in 6, even sometimes 7% yields right now. Traditional annuity markets, they just can't beat this. Secondary market annuities are really the highest yield, best investment you can find. Politics are pushing rates down, and all that means is that you should get in while you can. So my competitive advantage in this market is direct relationships with 40 different factoring companies. That $15 million of buying power I mentioned earlier requires the best deals from these suppliers. Through this website, there are exclusive deals that are available to you that no advisor even sees. It's like factory direct pricing without the markups. I've been doing this since 2011, and I have never seen a better environment for buyers. The combination of supply, rates, and lack of competition is creating exceptional opportunities. But, sometimes people hear about this market and they think this just sounds too good to be true. And I get it. I thought the same thing in 2011 when I first discovered this market. But here's why it works. It's not new. Structured settlements have existed since the 1970s. It's also not really secret. Court records are public and transactions are transparent. It's not risky. Same great insurance companies back these annuities that back your traditional annuities. In fact, a lot of times you get better credit quality through the secondary market. The thing is, it's just small. Like I said, it's only about an $800 million a year market versus $450 billion in the overall annuity market in a year. Wall Street really loves this asset class. It's just very small and esoteric. J.G. Wentworth spends millions on TV ads buying these payments to put together private placement bundles and asset-backed securities for institutions and insurance companies. Pension funds and other investment institutions also buy bundled blocks of these payments. But after 14 years and 500 million of transactions with zero losses, I can tell you it's definitely not too good to be true. It's just wholesale pricing in a market that most people don't know exists. Another question I get a lot is, what if I need my money back? So let's have an honest talk about liquidity. The reality is these are not liquid like stocks or CDs. You can't sell them tomorrow. You're committing to receive payments over time. This is for money that you want to convert into income. This is not for your emergency funds. But you do have options. I do routinely buy back payment streams from customers or from their heirs. The price depends on current interest rates at the time people need to make a sale, just like a bond price. There's no set surrender schedule or surrender penalty, but there's also no fixed liquidity provision either. Many clients start smaller or they buy a portfolio of assets. They start small to test the waters, or they use a portfolio just to give them options in the future if they need liquidity. The right mindset, though, is to think of this as a yield-to-maturity investment. It's the lowest cost way to get your money working and producing guaranteed income. They're a great tool for that specific job, but if you think you might need to surrender or give up on it and get your principal back right away, then this really might not be for you. It's really best to get started with secondary market annuities with a real clear understanding of your goals to match the available payment streams to your needs. For example, many investors have 5 or 10 years to retirement, so those deferred income streams like I showed you Dan had, those can really be really useful. Also, those lump sums like Brett and Jeffrey had, they can really help with deferred income. Others want to maximize Social Security, and they might need an immediate income stream to fill the gap right now. So whatever your situation, these payment streams offer a higher yield and a lower price for fixed income. Here's another thing I hear frequently. My financial advisor says this is risky. Well, let's talk for a minute about advisor conflicts. Often, advisors object because they can't earn ongoing management fees. The assets under management models for revenues conflict with period certain guaranteed payments like this. Advisors are often not familiar with the legal structure either. It removes capital assets from their management, and frankly, many times advisors prefer products that they can control and monitor and charge over time. So a few questions to ask your advisors are, can you explain specifically what makes MetLife backing riskier here than your recommended annuities? You could also ask them, how do the 6% guaranteed yields compare to your portfolio projections? Or you can ask them, what ongoing fees will I pay on your recommended product versus zero fees over here? Listen, I'm not anti-advisor. And in fact, I work with hundreds of advisors at DCF Exchange. But the reality is a little shocking. Many advisors come to DCF and they encounter secondary market annuities, and many of them buy them for themselves for their own retirement plan. But then they offer other products to their clients that pay higher commission, instead of offering their clients secondary market annuities that offer higher yields. That's just not right, and you need to understand if their business model conflicts with your goals. So really, secondary market annuities aren't for everyone. Let me be clear about this to see if it's a fit for you. This is for you if you want guaranteed, predictable income that you can count on, if you're comfortable making your own financial decisions after research, if you appreciate transparency and you want to verify things yourself, if you've got meaningful capital to invest as well, typically about $100,000 or more, if you want to convert some of that money to income and you value higher yields, but you don't want unnecessary complexity. Now, this might not be for you if you need maximum liquidity, as I mentioned earlier, or if you might need your money back soon. If you're looking for a get-rich-quick or a speculative return, this is not for you. If you need active investment management and handholding, then it might not be for you either. If you've got less than about $250,000 or so in total investable assets, that also might not be a good fit. These are great tools for the specific job of creating income now, income later, or lump sums. If you need that job done, these are the lowest cost and the highest yield way to do it. But if you're not sure of what you need, or if you've got limited resources, then these really might not be the best tool for you. So what's the next step? You've gotten some education in this presentation, and this has just been informational. It's not a sales pitch. But if this product interests you, here's what I'd recommend you do next. Answer a few quick questions to see if this might fit for your situation. If it's a potential fit, I'll send you some specific examples from our current inventory, and you can download and complete payment stream information and verify the math for yourself. There's also an opportunity to have a consultation with me to discuss your specific situation. Also, you should take some time to review with your CPA, your attorney, or your spouse to see if it's a good fit for you. So my approach here is really education first. I operate with transparency. I want you to check my work. There's no high-pressure tactics or false urgency. I'd rather have no transaction than a bad transaction. My job is to provide you the information, and your job is to decide if this really makes sense for your situation. I do this because I'm passionate about this marketplace. I don't just help conservative investors access the market, I actually created all the infrastructure and brought capital to the market that makes it possible for individuals and advisors nationwide. I built DCF Exchange into the wholesale clearing platform that serves advisors all around the country. But this website is my direct-to-consumer portal. Think of it like a factory outlet. I've got $15 million of operating capital securing the best inventory in the country for investors. And on this website, you get that factory direct pricing. You get exclusive inventory that's not available to that advisor network. With my capital and infrastructure, I'm buying every payment stream before selling it to clients. If I wouldn't own it myself, I won't sell it to you. So, in working with me here, you're not just buying from an expert, you're actually buying direct from the source. So, if you're ready to take the next step and learn some more, click the button below to answer a few quick questions. It'll take just 2 minutes or so to complete, and this helps determine if it might be a good fit for your situation. If you're a good fit, we'll talk about current inventory and if that suits your objectives. If it's not a fit, I'll point you to the right alternatives. So thanks again for your time. Go ahead, take a minute or so to do that quick assessment, see if this is a fit for you. I look forward to working with you.